Good morning. Look, I think the 10-year is telling you that the economy is stronger, but inflation also is much higher than expected and not as transitory. So let's start with the economy. Consumer, 70% of the economy is the consumer. Wages are going higher. Jobs are aplenty, with jolts at 11 million job openings. Savings rates still high, and retail sales are remarkably strong. And on the manufacturing side is also seeing a resurgence and a V-shaped recovery. Industrial production is only 2% below pre-pandemic levels, and inventories are at 5-year lows. So, and then yesterday we had durable goods, and you had cap goods shipments at a 10% annualized rate running in the third quarter from 10.6% in the second quarter. So economy is okay. Then you listen to people and CEOs like Expedia and Wynn and Kayak, and all are saying that things are starting to improve, especially as travel restrictions are getting lifted in Europe. So that's the good news. Inflation, it's much higher. We got PPI, we got CPI, we know all that. We heard from FedEx they're having all kinds of problems on the wage side, labor side. Seasonal workers are having to spend more. And also, General Mills is now expecting 7 to 8% inflation for fiscal 2022. So it's real. Wages are up. Rents are up. So all of this, I think, if you package it together, is telling you that growth is better, but inflation is higher, rates go higher. They're all interrelated, and that's why you're seeing this rotation in the market into cyclicals, economically sensitive companies, reopen names, and away from the NASDAQ tech-heavy names at this point. You're seeing it today.
Right. Tiffany, are you staying away from tech as a result?
Oh, I never stay away from tech. But to Steph's point, we are seeing this rotation and definitely into cyclicals. And I think, first, when we're talking about all this, it's really important to understand the importance of the 10-year. And, really what that is an indicator to us, to investors, in particular, professional investors, of investor confidence. And when you think about the fact that historically yield ranges have been very, very small, when you have, very small moves, they're a really big deal. So like last week when the 10-year hit 1.5, for the first time since June, that was a really big deal. And it tells us that investor confidence is very strong. You can look at what else happened last week. All signs are leading to this, right? So the Fed suggesting tapering and the market reacting positively, steepening of the yield curve. Also high yield corporate spreads widening just a tad, but really, at all-time lows. So when we think about this from a portfolio construction standpoint, as yields are increasing and as we kind of prepare for potential, definitely, tapering and rate increasing, I think investors need to be thinking about that portion of the portfolio. Like, how do you approach this from a portfolio construction standpoint? So a lot of investors will say, let's focus on the fixed income side with maturities and potentially, bond ladders. But, they also should be thinking about leaning into those sectors that do well in rising yield environments, like financials, like energy, things like that.
Hey, Stephanie, when you think about the inflation we're seeing, how much do you think is a function of wages and how much do you think is a function of this messed up supply chain we have? And the reason I ask is because I think it could have an impact, hopefully, I'm hoping it has an impact on how long this sort of inflationary period, how transitory or not it is and how long it lasts and what it really means.
Well, Andrew, the supply chain is really difficult. I mean, if you listen to Carol Tomé, CEO of UPS last week on CNBC on Closing Bell, she was not willing to commit in terms of when the supply chains are going to get fixed. But she certainly didn't say it was going to be the first half of 2022, right? So if you listen to some of the semiconductor companies, they're saying end of 2022. So I don't know if you want to call that transitory or not. I don't really think that is, quite frankly. But it's fixable, and it will get fixed eventually. Wages are a different animal, right? It's 70% of a company's costs. And they're running at about 4.3% annualized rate. That plus rents, right, as the eviction moratoriums get removed, those are stickier pieces of inflation, Andrew. We got to watch those pieces. And that's why I've been saying for months that inflation is not all transitory. Some of it is, not so much on other parts.